Hey, well, welcome back. Mark fielding-Pritchard here. Looking today at impairment of non-cash generating assets, which is IPSAS number 21. So another one in our long line of IPSAS talks. Trying to remain chipper as well. The whole family's got the flu at the moment. I look out the window and it's cold out there as well, which is a bit bizarre here in May. Right, we're looking at impairment of non-cash generating assets, IPSAS number 21. IFRS introduced the concept of impairment to us a few years ago now. When it first came out, impairment was, the new big thing, because it was basically a whole new topic and almost genre within accounting standards, so as exciting as that gets. No IFRS course is complete without its half a day on impairment and when it applies and when it doesn't apply. The reality of it is that it's been an incredibly hot topic, certainly as far as training courses, and allowed training companies to sell large numbers of courses. But the reality is that in real life, is that you hardly ever see the thing, because it has to be applied to whole classes of assets, and any impairments have to be material. So even for your standalone smallish company, if they have an asset which they think the value's gone down, the chances of there being any material adjustments are very small. So that's the background to this thing. We're obviously looking at IPSAS, so we've got some special circumstances here. First of all, IPSAS 21 only relates to non-cash generating assets. So that concept doesn't really exist within a normal private company or public company, a profit generating company, because everything is aimed at generating cash, either directly or indirectly. Whereas with the government, you're looking at providing services and so on. So that's the first thing. There's no analogous standard for this within IFRS. The second thing is, whilst you may spend lots of time studying it and never ever use it, once IPSAS is introduced, the process of impairment on an asset-by-asset basis is a very important part of implementation. Something that you will do, and those of you who've watched previous videos will have heard me talk about this thing called period 100. So you have the old cash system which ends, and the new IPSAS accrual system which starts, and we insert a period of time between that to make all of our IPSAS adjustments. Amongst those IPSAS adjustments, you will make impairments to assets which have fallen in value. So if you have motor cars which are recorded in your value at their original cost, you'll downgrade them to whatever their realizable value is, and so on. So back to the introduction, therefore. We have IPSAS number 21. There is no IFRS analogy to this. We're looking at impairment. It's really an implementation issue rather than a post-implementation issue, simply because of the levels of materiality that you would hope you would never be writing down whole classes of assets. And it relates to assets which are non-cash generating. And we're going to come back to that on the next slide. Okay, let's move on. Right, okay, so moving on to slide number 2 then. Notice here the very, very first line. It says it was introduced to address the fact that the public sector has non-cash generating assets. That is obviously true, but that is a huge, huge discussion point as well. And this is where you're going to have issues with this in real life. What is a cash generating asset and what is a non-cash generating asset? If you look at something like a road in itself, other than a toll road, does not generate any cash. So the immediate thought would be, well, it's a non-cash generating asset. Now, then other people would argue that what your road does, because your road generates economic income, it allows shops to function, you have distribution companies that obviously use the roads, it allows people to go from A to B, so home to work and so on. So the question is what is a non-cash generating asset? God, how many people have a Coke before coffee was invented? Secondly, what if you have subsidised housing? So many towns, for example, in Britain, you can rent a house or an apartment from the government, and we have what used to be called council houses back in my day. They actually generate some cash. But the cash that they generate is not really the prime purpose. The prime purpose of those apartments, those houses, is to provide cheap housing for people who otherwise would be homeless. So are they cash generating assets or are they non-cash generating assets? The view that you take will depend country to country, or the view that you take will also depend on your sort of political stance. More right-wing people want more cash generated from these things, more market rents and so on. As a general rule, the interpretation of the standard around the world where I've seen it is that other than situations where assets are specifically designed to generate a profit, then we treat them as non-cash generating assets. So in terms of application of this standard, it's applied to virtually all assets, even assets which on the surface of it may actually provide cash for you. Okay, so therefore we've got this idea introduced, but when will it actually be used in real life? Right, some of the other points then that I've just cut and pasted out the standard, not applied to assets held under the revaluation model. So if you have any assets which you are revaluing on a year-by-year basis, you might have city centre buildings that the government wants to show increases in value. Investment properties the standard wouldn't apply to, and so on. The value in use. Right, now remember this, with impairment, what happens is therefore, is we have what's called the recoverable amount and the carrying amount. So the carrying amount is what's in your balance sheet. Now we're going to do this again on a later slide, so don't worry if you have to think about it a bit, it's coming again. So the carrying amount is what's in your balance sheet. Right, you will impair if the recoverable amount, you can see me looking down, I've got it written in my notes here. You will impair if the recoverable amount is less than the carrying amount. So we put through an impairment entry. So if the recoverable amount is less than the carrying amount. Right, the carrying amount is net book value in your balance sheet. So what is the recoverable amount? Let me breathe. 1, 2, 3. Right, the recoverable amount is the higher of the fair value minus any disposal costs. So recoverable amount is the higher of the recoverable the recoverable amount is the higher of the fair value minus cost of disposal or the value in use. Okay, so we take the higher of these two things. Fair value minus cost of disposal, so what you could sell it for, or the value in use, so what's the value of the service it provides. We compare those two things and we take the higher. If the higher of those two things is lower than the value in the balance sheet, then you will impair. And the difference must be material. I've got it written on, I think it's the next slide for you. Don't worry if you didn't get it, bear with me. Don't bother to watch it again. It's coming again on the next slide. Right. Okay, so we put through an impairment adjustment. The impairment only needs to be considered if there is an indication of an impairment. Right, indications of impairments we'll look at as well on a later slide. Indications of impairment come in two ways, internal and external. So internal would be increased cost of operation, external would be complaints about the level of service. Okay, that was an introduction. The most important thing on that slide so far is that you understand this idea of when to use it. Most governments apply it to 99% of their assets because it's easier and just for the sake of consistency. If you do have governments who want to apply IPSAS number 26, which is impairment of cash generating assets, then you can do that as well, but do be careful with what you do. Okay, let's move on to slide number 3. Okay, so what we're looking at now is this idea that there have to be indicators of impairment. Now the standards 21 and 26 IPSAS and the IFRS both go down this route of giving you some fairly detailed advice on what you're looking for. As far as real life goes, I've got to be honest, I've never had any issues with this. It's all fairly obvious. Your issue in real life will be that people will resist the idea of impairing an asset, or they may resist the idea of impairing an asset. Or the other thing that you get as well is there may be no indicators of impairment, but the staff may be pushing you to impair it, and then you discover that's because the staff are allowed to buy the asset at its book value. So by impairing it, they're saving themselves money. Right, the indicators, internal and external. External factors would be reductions in the number of people served. Where I saw this in real life was the police in Moscow purchased a really rather expensive machine that was going to produce a couple of 100,000 driving licenses. So it was a machine that produced laminated driving licenses. And then when the thing actually went into use, they found that they produced 10% of capacity. Not because of any problems with the machine. Technically, it did exactly what it was supposed to do, and everyone said it would do. Just because the demand for driving licenses was 1/10 of what, for whatever reason, that they'd estimated. So you get internal evidence. Internal evidence would be excessive maintenance costs, excessive staff time on managing an asset, overruns in costs. So the actual cost of running an asset were much higher than you expected. Or external factors, usually if it's non-cash generating, so therefore the levels of service much lower than we expect. Sometimes you will have deliberately loss-making assets. We saw this in Britain, maintaining bus services to remote villages in Scotland, Wales, Cornwall and places. And they were there because it's a public service, and if you have old age pensioners in these areas, they still have some kind of legal right to get to the supermarket to buy their food. So therefore, as long as we're looking at the slide, we're looking at internal factors, external factors, use your common sense, much higher costs, much lower service levels mean that the thing isn't performing the way it should do. Therefore, at that point, you'll have to do an impairment review. Your impairment review is looking at your recoverable cost compared to your carrying cost, and your recoverable cost is the higher of fair value or value in use. As promised, I wanted to put a slide in that specifically just tells you about the mathematics of this thing. So once again, here we are now measuring the recoverable service amount. This is a separate part in this standard itself. Right, remember, what's going to be shown in your balance sheet is the lower of the recoverable service amount, or what we normally call the recoverable amount, and the carrying value. The carrying value will normally be your historical cost minus depreciation to date. So what's actually in your balance sheet? So impairment is required. Impairment is required where the recoverable amount is less than the carrying amount. Now remember, when we say less, it's got to be materially less. Yeah? And the recoverable amount, therefore, is the higher of the fair value minus any costs to sell. So in other words, the fair value minus cost to sell are what you're going to be able to sell the thing for. So that's your first value. Now you're going to compare that fair value with the value in use. Okay? So you're going to compare the fair value with the value in use. The higher of those two things give you your recoverable amount, and you then compare that with the carrying value in the balance sheet. Right, there are three ways in which we calculate this thing, which is the value in use. Then you'll see the three there: the depreciated replacement cost, the restoration cost, and the service unit cost. What we're going to do now is we're going to go through each of those in order. But remember, all the way through, the point of this is we take the higher of the fair value and the value in use, and then that is our recoverable amount, and then we compare the recoverable amount to the carrying amount, which is what's in the balance sheet. Right, just before we start this, let's just make sure that everyone's completely clear on exactly what we're doing. We're looking at impairment of non-cash generating assets. And what we said is that if the recoverable amount is less than the carrying value, we may need to make an impairment adjustment. Right, what is this idea, therefore, of the recoverable amount? Well, the recoverable amount is the higher of the fair value of the asset minus cost to dispose, or the value in service. Right, this idea, therefore, of value in service. Now, this is what we're doing now. There are three ways of calculating the value in service. You will use in real life the method which is the most appropriate for you, subject to the policy. So, calculating value in service. The first way to calculate the value in service is using a method called the depreciated replacement cost approach. So we're going to look at that first. There will then be a second method, which is the restoration cost, and then there will be a third method, which is called the service unit cost, the service unit method. Right, so you've got these three methods. In real life, you would choose the one which is the most appropriate. You will then compare that to fair value minus cost of both. Take the higher of those numbers, that will give you a recoverable amount, and you then compare that to what's in the balance sheet. Okay, value in use. Method number one, depreciated replacement cost. So you can read the slide yourself, but it tells you that XYZ, which is IPSAS, so it must be some sort of government body, has purchased an asset module, cost 100 grand. It estimates that the life will be 5 years. In year 3, a better computer, right? Notice that this is an asset module. So the asset module is part of the computer. So we're replacing the ERP system. So it tells us in year number 3, a much faster computer is introduced and XYZ decides to upgrade. So XYZ can upgrade its ERP system. It tells us that the asset module is not compatible with the new computer. Right, so therefore there are signs that this thing needs to be looked at in terms of impairment. Okay? Right, everyone okay with the scenario so far? So we're just looking at the value of the asset module. The asset module will be carried, or the asset module will be shown presumably as a separate intangible asset with a cost of 100,000 minus depreciation. And notice it's during year 3. It's during year 3 that this new computer is introduced, and so therefore we're going to be making any adjustments. I think when you look at the next slide, it's coming at the end of year 3. Right, please make sure that you're okay with this scenario. Asset module, indicators are it's not going to work anymore. We need therefore to calculate, do we need an impairment adjustment? And have a look at the very last line. It tells us that an asset module similar to the one currently in use is available on the market at a price of $60,000. So therefore your replacement cost is $60,000, okay? And we're going to assume all of this is happening on the very last day of year 3, very first day of year 4. Okay. Right, so let's just have a look and see what we've done in terms of our debits and credits then. For your calculations, the carrying amount at the end of year 3 is 40,000. Right, I hope everyone understands that. The original cost was 100,000. Make the assumption this is the end of year 3, so you've had 3 years of complete and exact depreciation. If it had a useful life of 3 years, assuming no residual value, the book value, the net book value, the carrying amount will be 40,000. I hope everyone understands where 40,000 comes from. That's the original cost of 100,000 depreciated by 3 years. Right, on your slide you were told that the replacement cost of whatever this thing is now 60,000. What we're going to do therefore is we're going to assume that that thing was held for the same period of time. Right, the same period of time is 3 years. So if the asset had been purchased not for 100,000 but for 60,000 and it had been purchased 3 years ago, then the net book value would be 24,000. We assume it had been purchased 3 years ago, we assume, for 60,000. If that had been the case, 3 years depreciation is 36,000, so what is remaining is 24,000. So the value therefore, or the net book value, had it been purchased at this reduced price, would be 24,000. Your impairment loss therefore is 16,000. Your impairment loss being what's actually in your balance sheet, net book value of 40, minus the net book value that would have been there had the thing been purchased at this reduced value, 16,000. So therefore, to get that in our books and records, and there are various ways you can do this, and it's funny with impairment that we talk about impairment losses, but actually how you get the debits and credits in your account rarely seem to be discussed. But the way I would do it would be to debit depreciated to debit accumulated depreciation 24,000, debit impairment expense, so you can have an expense in your income statement of 16,000, and credit the fixed asset at cost. So what will happen then is your fixed asset will now resemble this depreciated cost. It will show a cost of 60,000 and it will show accumulated depreciation of 36, giving you a net book value of 24. Okay, that's a depreciated replacement cost approach. It's used in real life where you have things like computers, which are high-tech items. because high-tech items will reduce in initial cost over time. All of your laptops and so on have been getting cheaper and cheaper and cheaper over time. And so that's what we've got here there, the depreciated replacement cost. That is the first of three methods of the way in which we can calculate the service value. Okay. So now we have method number two. Remember what we're doing? Method number one was simply a way of calculating the service costs with this idea to get to what is the recoverable amount. So we had this idea that we had depreciated replacement cost. That was method number one. Right, method number two, therefore, is going to be the restoration cost approach. Right, method number two is the same as method number one, except that now we also take into account any costs to restore the item. Right, let's just have a look at the example and then we'll come back and mention that again. Right, so under the restoration cost approach, the recoverable service amount is the depreciated replacement cost, and then we also take into account any costs to repair the item. So let's have a look at the example, because I think the example explains this quite well. XYZ owns snowplows. They're purchased at 750 grand each. They're expected to have a useful life of 10 years. After 3 years, two of them are in an accident, so let's assume they hit each other, and it tells us that the cost of repairing the plows will be 350,000 in total. Right, notice that's in total. The estimated cost of a brand new plow is $900,000. So each new one will cost $900,000. Right, look at what's happening here. In the first example, with the depreciated replacement cost, we had an asset and the cost of a new asset was getting lower and lower and lower. So typical example where you would see that is technology with computers. In this example, now what's happening is we've got the replacement cost of an asset and the replacement cost is rising. So the cost of this thing is getting higher and higher and higher. What we're going to do, therefore, is we're going to take the replacement cost, which is now higher, then we're going to depreciate it, then we're going to take into account the restoration cost, the repair cost. Okay, make sure in your head that you're clear what you're doing. We are calculating this idea of recoverable service amount, which we're going to compare with the fair value. The higher of those two, we will then compare with the carrying value in the balance sheet. First method, depreciated replacement cost. This is now going to be depreciated replacement cost, but taking into account repair costs as well. Let's go on to the next slide and let's have a little look at how the maths work. Sorry, my webcam seems to be playing up today. Right, so what we saw was the carrying amount at the end of year 3. Remember we said that 3 years in, these two snowplows had an accident, so therefore the carrying amount is 1,050,000. How do we get that? 750,000 was the cost of one. 3 years have gone, so we've got 3 years depreciation, and then which gives us what, 525,000 remains, and there's two of them. Remember we're talking about two snowplows. So therefore the carrying amount, the figure which is in the balance sheet before any adjustments whatsoever, is 1,050,000, and that's at the end of year 3. Now what we said that we're going to do with this is we're going to do what we did last time. So we're going to take the depreciated replacement cost, but then we're also going to take into account repair costs. So the replacement cost at the end of year 3 is 900,000. That's for one snowplow, but we're told that there's two of them. So the replacement cost is 1.8 million. The accumulated depreciation is 540,000. We've had the thing for 3 years. So on 900,000, the depreciation would be 90,000 per year for one snowplow. We've got two. So therefore your accumulated depreciation, 3 years, two snowplows, initial cost of 1.8 million for the pair, it gives you 540,000. So the depreciated replacement cost using the first method would be 1,260. Right, you can all see that 1,260 is higher than the carrying amount, so there's no impairment required at the moment. But we have to take into account the restoration costs as well. So the restoration costs are 350,000. So therefore, on the basis of that, we get a service value of 910,000. 910,000 is the depreciated replacement cost, 1.26 million, minus the restoration cost, 350,000. So the recoverable service amount is 910,000. What's in your balance sheet? 1,050,000. Recoverable service cost is 910. So your impairment loss, therefore, is 140,000. Okay, it's the same as the first method, except that we've taken into account the repair cost as well. And you will do that because in the first example, what's happening is that you're not doing anything to the asset, you're simply reducing the value. But in method number 2, you are actually going to take the thing in and repair it. So therefore you will have to actually undertake this repair cost. Okay, that's method number 2. Okay, just before we press on with this, just have a look at the very end of slide 8. I just added a bit after I did the sound. So I put the debits and the credits in there. There is no strict way of telling you how you should actually treat this. When you get an impairment loss, you can calculate the number, but what does it actually mean and where does it go? No one tells you that. So I've actually increased the cost of the asset and increased the accumulated depreciation. The difference in those two increases is 140, I think, and then we just treat that as an expense. You will then depreciate your snowplows over 7 years after that with the balance, 910,000, what's left. Pretty much it's up to you. Right, you've seen two methods therefore. So you've seen depreciated replacement cost, taking into account repair costs. The third method that we have, again, is very, very similar. It's really the depreciated replacement cost all over again, but now we're going to take into account falls in service provision. This happens where you estimate the use of a service. So I talked about the one that this is what we did in real life, where they purchased a machine and the machine was able to do, I think it was something like 100,000 driving licenses a year, and then the demand for driving licenses was only 20,000 a year. So we impaired the machine, and we actually we doubled its useful life as well, because the thing was going to last forever. There's nothing wrong with the machine at all, they just overestimated demand. So service units approach is where there is a decline in the output and a reduction in the extent of use. We therefore, there's a whole blurb on here, you can read it yourself, but we take into account what is the depreciated replacement cost, and then we take into account the fall in service. Once again, easiest way to explain that is by doing a little example. Okay, so we looked at a couple of methods. Remember what we're doing? We're getting this idea of the service cost, which will then give us the service cost compared to the fair value. The higher of those two we then compare with value to the balance sheet. We saw two methods. One was depreciated replacement cost. That was the first method. Then we had the second method, which was the depreciated replacement cost taking into account any repair costs. And you saw that what was happening with the first one was that we had an item that simply wasn't as good at doing what we wanted it to do as we thought it should be. So you had things like technology, computers where they're falling in value. In part number 2, we saw we had assets that were increasing in value, but we had to take into account these restoration costs. Now what we've got is we've got to have an asset, and this is the one I told you about that I saw in real life, producing licenses. So this is number 3, which is an alternative to number 1 and number 2. Number 1 being the depreciated replacement cost, number 2 depreciated replacement cost minus replace. Third offer is going to be what's called the service units approach. The service units approach is simply the depreciated replacement cost, and then we take into account the fall in the units of service it can provide. Right, what does that mean? Again, much better than I can say. Let's look at an example. So we've got it's IPSAS, so we've got a ministry, whatever. It acquires a printer for 250,000. So let's assume it's producing marriage certificates. It was expected that it will print 5 million certificates over 5 years, so assumption $1 million a year. 2 years after acquisition, something goes wrong with it. And when something goes wrong with it, now over our 5 years, we're only going to get 4 million. Right, the part is replaced at no cost to the entity. 2 million copies have been printed to date, and the current replacement cost of the printer is 250,000. Remember, we're always starting with the replacement cost. So keep that 250,000 in mind. Notice that phrase as well, 2 million copies have been printed to date. Okay, so the old asset was purchased at a cost of 200,000 and 2 years have gone by. So different from other two examples, only 2 years. So therefore the carrying amount, the net book value will be 120,000. The current replacement cost is 250,000. So on that basis, if we take this idea of depreciated replacement cost, the depreciated replacement cost would be 150,000. 250,000 times 2 years. So 250,000 less 40%, 2 years, gives us 150,000. With the recoverable service amount though, we now take into account the fall in service value. So the depreciated replacement cost is 150,000. Right, so we've got 150,000. Now remember, when we first started this thing, we assumed that it would produce 5 million marriage certificates. How awful. So 5 million marriage certificates. And the question told you that 2 million have already been produced. So looking over the remaining 3 years, we would have expected, get my tenses and verbs correct there, when we first started this thing, we're looking at this going, yeah, it will produce another 3 million. Now, because of the replacement of some cheap part, whatever, it's telling us that it's not going to produce 3 million, it's only going to produce 2 million. So we need to reduce the depreciated replacement cost of 150,000 to take into account that fall in production of units. So look at your slide and you'll see that the depreciated replacement cost was 150,000 and we're multiplying it by 2/3. It's being multiplied by 2/3 because we previously thought we'll get 3 million more from this thing, and the reality is that we're only going to get 2 million more. So therefore what's going to happen is that you're going to have an impairment loss of $20,000, which I very much doubt is material. But that's how the calculation goes. Okay, that's IPSAS number 21. It's an important standard because it's an important standard in its own right. It's likely that you're going to be doing this before implementation rather than afterwards. You need to be able to do those calculations, bearing in mind that you will pick one of those three methods, which is the most appropriate. You will then compare that to your fair value minus cost of sale. That will give you a recoverable amount. You compare your recoverable amount to what's in the balance sheet. It's something you're going to be doing a lot of. And you need to understand how those three methods work. And notice that the basis for all three is this idea of depreciated replacement cost. Then either making no adjustment or making an adjustment for repair cost or making an adjustment for fall in the number of units. And you never use it where you're getting the thing revalued every year. Okay, that's it for 21. My name is Mark. Thank you very much. Please contact me if you have any questions on that. Anything that you're doing in real life. We have some experience with doing this in real life. Thanks a lot. Thanks for watching. Oh, and remember to like us on YouTube and like us on Facebook and just like us in general. Thank you.